Hello, and welcome to today's webinar of United Methodist Personal Investment Plan, or UMPIP. I'm Cheryl Hatcher, Benefit Educator here at Wespath, and along with me is
Frank O'Brien, Senior Benefit Educator. Good morning or afternoon, as the case may be.
Yes, so we're excited to be here today to tell you all about the United Methodist Personal Investment Plan. So today's session is going to be recorded, and it will be emailed out to you as a link probably within the next week or so. And behind the scenes, we also have another fellow benefit educator, Todd Creviston. He is going to be answering any of the questions you put out there in the Q&A box. So feel free to put in any questions you have. He will answer them during this webinar, but if we get a bunch of questions and we're not able to answer them all, we will send out an email with the response afterwards. So those are our housekeeping tips. Are we all good?
We're all good to go.
We're all
Absolutely.
good to go. So let's get going. Let's talk a little bit more about Wespath. Who are we? So we are a non-for-profit organization. On a daily basis, we handle between $25 to $26 billion in assets every day. So that's a lot of money that we're handling. And this actually goes toward our 100,000 participants. That includes surviving spouses, retirees, and of course, active working clergy. We are the largest reporting faith-based pension fund in the world, and we're very proud of that. But what gets us up and out of bed every morning is that blue box that's on your screen now. I'm going to read it out to you because it's something that we all take to heart. Caring for those who serve by providing investment and benefit services that honor the mission and principles of the Methodist Church. So that's what gets me up and going every day. We love being able to impart our wisdom onto others to make sure that they have great investment options and into retirement. So our agenda today is, what is UMPIP, United Methodist Personal Investment Plan? We'll go through the different contribution options that you have, whether that's investing on a dollar amount basis or maybe on a percentage basis. What kind of plans do we have? Investing with Wespath, what all the different plans do we have? Frank will talk more about those. Assessing your account, either before retirement and also during retirement. It is your money. There are ways for you to get it out. And also participant resources. We've got a number of them. We'd like to say a plethora of resources that are available to you. So we will go through all of those as well. Now, what is UMPIP, or the United Methodist Personal Investment Plan? Well, it's actually an account balance or defined contribution plan that you can actually put money into yourself, as well as plan sponsors can actually put money into that. You decide how much to put in, whether on a dollar amount or on a percentage based, and that is actually taken from your paychecks. Again, you decide how much to contribute. Do you want that to be a flat $100, maybe $500 a month, or a percentage based? We do recommend the percentage based of your compensation, because then as your salary increases, so will the amount that going into your retirement plan will increase as well. How to contribute, and that is also part of that as well, and also the different funds that you can actually be invested in. How is your money invested? All the different plans that are available to you. Do you want to self-manage those, or do you want us as Wespath, using our life stage investment management program, do that for you? A lot of different options for you. That's why this is such a great voluntary plan. Some of those advantages that we can talk about are you can actually save on taxes. So if you're putting money in on a before tax basis, which we will go through the different types later on as well, you can actually avoid some of the distribution taxes when you actually receive a distribution. And then if you're putting money in on a Roth basis, any of those monies, the earnings on those could potentially be tax-free. Another advantage is having that autopilot solution. Having life stage investment management actually handle your accounts, whereby we are actually determining what would be the best mix of funds for you during your stage of life. that is something that Life Stage Investment Management does. And also, when you take distributions, we can have Life Stage Retirement Income actually let you know how much you could receive on a monthly basis to last for your and or your spouse's lifetime. Employer contributions is another advantage. Possibly there is a matching or maybe a non-matching type of contribution your employer can put in for you. That's just another additional amount going into your retirement. It could be on a discretionary or it could be an additional basis, but definitely contact your employer to make sure that and see if there is one that is available for you. Another advantage is sustainable investing. Your money is invested in diverse long-term sustainable investment funds that we have at Wespath, and there's different funds that are available that Frank will review with all of you. And some of those are more on a discretionary basis, or ones that you can actually have more say in what those funds would be. And then also another great advantage that we have is EY Financial Planning Services. This is just the first time we're going to be talking about them, but they are comprehensive financial planning services. That they're a wonderful partner that we have with them, and their services are available to you at no cost, no additional cost, I should say. The Wespath funds actually pay for their services, but they've got nothing to sell you. This is something that want to make sure that, again, you have the best retirement and your plan along the way into retirement. So those are the advantages of participating with UMPIP. I'm going to transfer it over to Frank, who's going to talk about the plan information.
Thank you, Cheryl, very much. Excuse me. We'll get a little further into those life stage programs that you just got highlighted a couple of times. I'll later on get into life stage investment management. Cheryl will come back to life stage retirement income. So you'll see how our plans and programs all kind of work in harmony to provide ongoing support in your investments of your contributions, and then the ability to provide ongoing support to you as in the future you start to receive your retirement income distributions. Now, as far as the UMPIP plan setup is concerned, there's certain plan design features for you to be aware of. Now, your employer or plan sponsor, as they begin to sponsor the plan for their employees, fills out a document called an adoption agreement that adopts the UMPIP plan, and then they make several choices as to how they want to design that plan for their organization. So the first thing is eligibility, who can participate in the plan, whether or not employer contributions will be made, and if they are, how. Vesting or ownership of the employer contribution account, when that might happen. And then we'll talk about quickly, there's a contribution election form and enrolling in the plan, still somewhat form-based, although we are efforting right now the ability to have some of this occur through the benefit access portal that we'll talk on when we get to the resources later on. So as far as eligibility is concerned, just to note that when you come into the organization and they have sponsored the UMPIP plan, you are immediately eligible to make employee contributions. So that's what the contributions that are coming by percentage or dollar election from your pay per payroll, and you'll hear about various contribution types momentarily when we get back to Cheryl. But as it relates to the employer contributions, there may be some conditions of employment before eligibility to begin to receive the employer contribution may come into play. So as it relates to an attained age, that's one criteria that can be there. It may be immediate or based on that attained age, for example, age 21. It could be immediate or based on a period of service. So for example, 12 months of service prior to your ability to begin to receive those employer contributions, or based on annual hours of service. For example, 1,000 hours worked per year. That's kind of a full-time employment status, 1,060 hours. That's when people are considered to be working full-time. So that could be how the eligibility criteria is being set up for you to receive your employer contributions. But again, you're eligible to begin to participate, to start to save for your retirement upon employment with that organization. Now, with the employer contributions, They may be provided in one or more of the following ways. Quite honestly, they may not be provided at all. The plan sponsor, for their reasons, may be providing the plan for participant contributions only, but hopefully most of you, if not all of you, are receiving some form of employer contributions. In our environment, the most common type of employer contributions would be either an employer matching contribution or non-matching contribution. So when we talk about the employer matching contribution, let's say, for example, you're contributing 3% of your pay into the plan, and your employer is matching dollar for dollar up to that 3% you're putting into the plan, so that rounds out to 6% per payroll is actually going into your plan. The employer could design the plan where if you contribute up to 6% out of your pay, then there'll be a 3% matching contribution that is provided. So that is at the discretion of the employer upon completing that adoption agreement. Now, with the non-matching contribution, the employer may say, we're not going to worry about the extent to which our employees are contributing out of their payroll. We're going to contribute 2%, 5%, 6% on an ongoing per payroll period basis into an employer non-matching contribution account. Again, go back to take a look with your employer human resources representative to understand how these plan design features are set up for you. Now, there are conditional and discretionary contributions that can be made. That would be based upon certain performance metrics, certain financial metrics. So in our world, we may not see that as much as in the secular world, but still, your employer has the ability to say, based on X, Y, and Z, we're going to provide an additional contribution in any given calendar year if X, Y, and Z was satisfied. So that could be the case with your particular employer. Now, as far as vesting is concerned, vesting basically means ownership of the account in the retirement plan. Just note that all of your personal contributions, be it before tax, Roth, or even after tax, rollovers, that's always 100% vested in your account. But the employer may decide to have a vesting schedule to determine how and when the employee will be fully vested, partially vested in the employer contribution account. Now, a lot of times we will see that an employer will set up vesting to be immediate. As soon as you begin, as soon as your eligibility to begin employer contributions is satisfied, employer contributions go in, they're 100% eligible, which means they're fully portable if you were to go somewhere else. Rollover out, if you will. Some employers may set it up so that after 3 years or maybe 5 years, there's what's called a cliff vesting schedule, which means you're working, you're doing your employee contributions, they're contributing employer contributions all along the way, then you get to like the 5th year, and then boom, you hit the cliff, all of that immediately becomes 100% vested to you. Or there could be a schedule. After 1 year of service, you get 20%, 2 years of service, you get 40%, up to 5 years of service, you get 100%. So again, check back with your contact at your organization to understand how that vesting may work for you. As far as enrolling in the plan goes, you could go to your human resources department, again, whoever that resource is for you, and to participate in the plan, and you complete an initial enrollment form, and on that enrollment form, you'll be determining what contribution type you want to contribute to, and again, dollar or percentage. And that's that initial enrollment. For now, for ongoing changes to your contribution election, and you can make these at any time, you can change your contribution type and your contribution election, be it dollars or percentage. You would just complete this contribution election form and provide that to your HR or payroll department within your organization. And we are efforting right now the ability to make these changes once initially enrolled online. So hopefully sometime next year, you'll hear more about that development for the benefit access portal that we have. So again, you can increase and decrease at any time. And I'm just going to shout out again that percentage or dollar amount. In our world, we will always recommend doing a percentage because you may not be able to put more into the retirement plan 1 year over the next. But if you get a wage increase, that percentage is automatically going to lift the dollar amount that's coming out of your pay each pay period. So in effect, you are putting more money into your account. So we would recommend the percentage over, $200 a month or something like that. But you have the option that suits you and tailors to you the best. So So those are just some plan design features to be aware of. Again, speak to your contact at your organization if you have any questions particular to the organization that you're with. So now you know how to enroll and different options that you have. Now we'll talk about the various participant contribution accounts that you can elect to contribute into the UMPIP plan. So, Cheryl?
Excellent. Thank you very much, Frank. So what I wanted to talk about is about the most common contribution scenarios. So that right now is before tax as well as Roth. And another plug for EY Financial Planning Services. If you have any questions regarding either of these or what might be best for you, please feel free to contact EY. I want to talk through each of these and what the ramifications are. For UMPIP, on a before tax basis, this means that you're avoiding tax now. So when you are actually having your paycheck, you have your gross salary, and then we have those contributions going into UMPIP right away. So they're not taxed. So any contributions and any earnings on those contributions that you've had over the years, that will not be taxed until you take that amount out in distributions. Okay, so how it comes in, either if it's taxed when it comes in, then it's not tax going out. If it's not tax going in, it's going to be tax going out. One way or the other, the tax man needs to get his money. So that's for the before tax method. For a Roth contribution, this is where you actually have your gross salary, and then you have your taxes taken out, and then you put your money into your retirement savings plan. And those contributions for the Roth basis, those contributions and any earnings on those contributions will be tax-free, provided you meet all of the information that's in the second bullet, the criteria in there. So your first contribution must have been at least 5 years prior to the first withdrawal, and you must be either 59 and a half or older, permanently disabled, or deceased. Any questions regarding the Roth contributions, again, definitely can contact EY if you have questions on that. Now for 2025, these are the contribution limits. This is set by the IRS and usually goes up each year, but for this year, this is something a little bit newer. If you're under age 50, then you can actually contribute $23,500. I know these numbers are high, they look high, and don't feel, I don't want you to feel like you have to contribute this amount. Just contribute what you can reasonably afford, but here are some just limits on showing you how much you could additionally put in, maybe if you didn't put in earlier in your salary working years. At age 50 to 59, you can actually put in what's called a catch-up contribution, an additional $7,500, so that would be a $31,000 total. But the little caveat in this one is for this year, if you're aged between age 60 and 63, you can do what's called the super catch-up, and you're actually putting in an additional $11,250 for a total of $34,750. And then at age 64 and older, it goes back down to the $31,000 that you can put in. Now, I tell you this just not to make you scared, but just there are limits out there how much you can put in. And this is IRS regulated, not through Wespath. But should you be able to put in more than these amounts, you have the ability to put in what's called an after-tax basis. So if you're putting in more than that, you can do that and putting money in after tax. So any earnings that you have on those after-tax monies, those are actually going to be taxed in distribution. Okay? Now, rollovers. Rollovers is one of my specialties, and because I wear many hats at Wespath, one of mine is being the rollover specialist, or what I like to call is being the rollover queen. So I actually have my own tiara. So what this is actually moving money from any previous employer plan into your UMPIP plan. So if this is not your first position and you've had a job outside of this, and you want to, and it's a qualified retirement plan, or maybe a traditional IRA or other types of forms of retirement plans, those could be moved over into UMPIP. It's really not too difficult of a process, but we do have a form that has to be completed. There might be some documentation you might need to do with your financial institution. But feel free to contact me if you have any questions regarding the process. And you can also contact your tax or financial advisor to see if there's any questions regarding the process, or if this is a good and viable option for you. And of course, EY is there to help you as well. Okay. Now we are going to go over into investing your account before and after retirement. Back with Frank.
Thank you very much, Cheryl. I do think Cheryl has more than one of those tiaras because it seems to pop up pretty much wherever we have our webinars together. So you're enrolled in the plan. You've decided the contribution type that you want to contribute to, the amount that's going in per payroll period. But now you are investing in what I call the Wespath family of funds. And there are advantages to invest with Wespath. One of them is we do, and I will review with you, we do have a diversified set of investment options. That's the way you want to contribute or invest for a long period of time. So we're going to have some funds that are very conservative in nature that are intended not to have great gains in those funds. Middle of the road funds that have some risk and potential rate of return, and then some that are more aggressive. Equity funds, international equity fund, that certainly has a higher degree of risk, but a higher degree of potential return. And we'll go through the funds, and then I have a chart that kind of gives that risk return type of perspective. So that's a good positive to have in any type of investment vehicle that you have, and certainly we provide that for you here. Now we have competitive returns relative to benchmarks. Our funds are what we would be considered to be privately managed funds. In other words, they're not out in the retail space for individuals to come in and go into those funds, right? They are just for us here within the UMC and related organizations. We do look at the marketplace to ensure that these investment funds are operating as the general marketplace is. We have investment managers working behind the scenes in our fixed income funds and our equity funds, and we benchmark their performance against market performance to make sure that the funds that we have are performing as they should be performing in any given point in time. So we do benchmark ourselves against our peers in the marketplace, if you will. We have low expense ratios. Because we are who we are, we're a large organization, $26 billion, that gives us economy of scale. We can have low expense ratios. And with that, there are no commissions being paid out of the funds. There's no stakeholders, there's no shareholders, there's no dividends going out to the general public every quarter based on fund performance or anything like that. If one of our client relationship managers comes across a Methodist school and they come into UMPIP, they don't get a commission, they don't get a run rate on performance return over time. The money stays where it belongs, and that's within the fund itself for all of us to benefit from that investment fund. And with the expense ratios, even though they are low expense ratios, they actually pay the overhead for Wespath. So it's not just salaries, pens, pencils, and clickers. It's also life stage investment management, life stage retirement income, EY financial planning services. We all pay for that by virtue of the operating expenses within the investment funds. I'm going to talk about life stage investment management. That's the program where you're asking us to tailor the investment allocation for you over the long haul to get you through, into, and through retirement. EY Financial Planning Services, again, always speak to them. You're going to hear about them again throughout. And then we have sustainable investing. We practice sustainable investing, and that really means two things. First of all, sustainability for the long haul. Now, we've proven that we can do that. We have been around for 111 years or something like that, I believe. We have been paying out retirement income for a good period of time. We're doing it today. We have every intention of doing it as far as the eye can see. But for us, sustainability also means the philosophy that we take when we build our investment funds. We believe in environmental, social, and governance principles that guide how we will invest in those funds. We have screenings. We will not participate in certain industries like tobacco, alcohol, firearms. We will not engage in our fixed income funds with countries or foreign companies that we do not believe in their principles of how they go about human rights treatment, either at the government level or the corporate level. We will not get engaged with those. So we make sure that not only are we having that sustainability for the long haul, but we're also upholding the values of the church. With the investment categories, we'll kind of go from the lowest risk to the highest risk with one little exception. Here we have the Stable Value Fund. It's a short-term income fund. It is a capital preservation fund. It is a fund where it is intended to not lose money, which means it's not really has any real risk or a lot of risk at all in how that fund is set up. But it's got some features around it where that capital preservation comes into play. So if you're early career or mid-career, you won't see the Stable Value Fund. But as you get into retirement, that stable fund becomes more available because you want to have some stability in the account overall because you're starting to get your retirement income stream. So you'll see that along the way. We have 3 fixed income funds. These are bond funds. These are debt funds, right? Governments are putting out bonds and notes and bills. It could be the United States. It could be other sovereign nations around the world where we are accumulating those for our funds. So we have 3 of those. The first is the Inflation Protection Fund. Now, this is a fund that invests in Treasury inflation protected securities that come from the Treasury. This fund is designed to help us keep pace with purchasing power over time. It is gauging against the domestic inflation in our economy at any given point in time. Our fixed income fund is either our largest or the second largest investment fund, and that gives us a whole range of different types of these bond and debt securities. So it could be these treasuries, the bonds, could be corporate bonds, it could be international bonds, international corporate bonds, all kind of built in there. Because you have that range, you have a higher degree of risk, so a higher potential rate of return. And then the extended term fixed income fund is kind of a carve out of the fixed income fund where we're looking at those bonds that are longer term. 10-year that you hear in the press all the time, 30-year bonds that we'll hear about now and again. It's the longer end of the bond market, as they say. No one knows what the economy is going to look like tomorrow, more or less 10 to 30 years out. So with that, there's a higher degree of risk. They call it premium risk. But with that higher risk is a higher rate of potential return. Moving on, if I take you to the bottom of the screen, you can see our equity funds. We have the U.S. Equity Index Fund. That is a fund that is actually utilizing what we call the Russell 3000 as the benchmark to purchase the securities that go into that fund to match and get a little bit better in performance than that index. There's the U.S. Equity Fund. This is a broad range of U.S. equities, company stocks. It's a U.S.-based company stocks. High risk because the companies have risk in terms of their performance over time. Here we will go and get the large companies, those companies we hear about in the press all the time, but also mid-sized companies and small companies. We'll put that into the blend under the U.S. Equity Fund. And then I have a thing called growth. Those, again, are the ones we hear on the news all of the time. The Alphabets and the Metas and all of that continue to grow. NVIDIA continue to grow. But also what they call value funds, where the professionals say, company ABC we think is undervalued in the market, it's going to go up, so they'll bring that into the portfolio, and if that happens and that company goes up, we can benefit from the earnings from that as well. Then there's the International Equity Fund. This is company stocks, but of foreign companies. So Sony and Siemens and those types, I think Alphabet might even be a foreign company now, that get baked into this. Same thing, large companies, small companies, mid-sized companies, growth companies, and value companies. So all of that gets blended together. But with an international equity fund, you have a higher rate of risk. Some of it is geopolitical, but some of it just gets to just currency exchange and those types of things. So the higher the risk, the higher potential rate of return, and you'll see that in that graph I'll show momentarily. But to bring you back to the top, we have what's called a balanced fund. It's a mix of stocks and bonds. And our fund is the multiple asset fund. And what we do here is we intentionally set the fund up to have 2 pieces of our equity funds in there and 2 pieces of our fixed income funds in there at a percentage rate. So 35% U.S. equity, 30% international equity, 25% fixed income, 10% inflation protection. So in that balanced fund, you're actually getting diversification baked into that one fund. So if you're comfortable doing that and you want to do that, more than willing to go in and do that. With that fund, it stays static to that 65%, 35% mix. I'm going to come back to that when I talk about life stage investment management. And as you can see, instead of building this fund from scratch, we actually call it a fund of funds because we're using the funds that we already have in place to kind of blend together to create that multiple asset fund. As I indicated, we do believe in environmental, social, and governance principles, human rights principles. So within the context of the overall denomination, at the denominational level, agency level, annual conference level, there are often some movements to get our funds to be even more sensitive, more heightened to those principles, those philosophies that wrap around these funds. So we have the Social Values Choice Suite of funds where you can, if you are so inclined, to continue to contribute into those funds because of that heightened sense of the ESG principles and the screenings that we apply. Here is just kind of representation of what I was hitting on with risk, excuse me, and potential return. Stable value fund, capital preservation, intended to kind of keep that capital as it is without much earnings. You can see that low rate of potential return. Those fixed income funds, they go up the scale of the risk scale with the potential rate of return. Inflation protection toward the bottom, fixed income in the middle, that extended term because you're out there at the end of that bond market, 10 years and 30 years. The multiple assets, a blend, and then you have your equity funds on top. Now this is a historical view of these funds or asset classes, but as we know, they can go topsy-turvy at any particular point in time. We're experiencing market volatility now. But when we talk about long-term investing, and we are, and you are long-term investors, investing for retirement, this is the historical view of how these asset classes and therefore these funds perform over time. Now, life stage investment management. It is the program where you're asking us to tailor the investment allocation for you of our funds. Just to let you know, the social values suite of funds, the multiple asset fund does not fall into life stage investment management, but the other funds do. We set up a personalized investment management tool for your defined contribution accounts, so your personal investment accounts, any employer matching or non-matching contributions that you're getting. And we manage that during your active service as well as within retirement. If you stay with us for retirement and get your installment payments from us, you can stay in life stage investment management if you so choose. And the way it works is we set an allocation based on information around you, your age, gender, risk tolerance, Social Security benefits, those types of things. And we set the allocation and then we review it quarterly. And if your allocation goes over thresholds where we want it to be at this point in time, we will rebalance that account as needed. But there's two time frames that I want to share with you as it comes to life stage investment management. The first is the long haul. So I'm going to use an example of somebody who's 55 years old, got a good number of years left before retirement, and we're going to put them in at a moderate risk tolerance of 70% of their account is in those equity funds, and 30% of the account is in those fixed income funds. And as we age up, the amount of that equity exposure slowly and certainly comes down, and the amount of that fixed income side goes up because we want to keep the risk for the return on the equity side, but we need to increase the amount on the fixed income side because eventually we're going to be paying retirement income. So we have a glide path that continues to manage that risk portfolio based upon age and length to retirement and then through retirement as well. But the second time frame is we look at you quarterly off of your birthday. So quarterly off your birthday, we look at you and we say, hey, we want you at 70-30. Market's been good, you went to 80-20. Well, that sounds good, but that's not where we want you right now. Or the bond market rallied and now you're at 60-40. Well, that might be good, but that's not really where we want you right now. We want you at that 70-30. So we're going to rebalance that account to get you back to where we are. And because we're actively managing the account during the course of the year, during the course of time, while doing that glide path, I can say that there's a marginally higher internal rate of return that you would receive from that portfolio as opposed to setting you up at age 55 at 70-30 and waiting till you're 60 and going to 60-40 and waiting till you're 67 and going to 50-50. We do it along the glide path, and then we look at you during the course of the year on a quarterly basis So that's really how we manage that portfolio for you. Very, very powerful program. Again, we're looking at certain elements of the individual, the participant, the age, benefits commencement date. You can tell us what your benefit commencement date is going to be. On benefit access, you can set up your life stage investment management profile. You can tell us your risk tolerance. Are you a conservative investor, a moderate investor, or an aggressive investor? And if you're not quite sure, EY Financial Planning, their website has tools. You can have that conversation with them, and they can help you kind of figure out where you are right now, and that kind of helps you sleep at night. Okay, we'll assume Social Security benefits for all lay employees. For clergy, that can go one or the other way. And then with that, we have that diversified investment portfolio that we manage over time. If an individual goes into our plans and starts to contribute, receiving employer contributions, and they can see the money's getting allocated, but they really haven't done anything and they just kind of leave it that way, well, it's a default position within life stage investment management. It's going to be a moderate risk tolerance, so middle of the road risk tolerance. We're going to assume a benefit commencement at age 65, even though that could be, it's before our Social Security date, but we'll still use that if we have not been given any other direction. And we assume eligibility for Social Security benefits. So if you're not really sure if you've done anything with the investment allocation, you can be assured that you are in life stage investment management. Whether or not you are self-managing. Now, you can self-manage. I should come back around to this. You can self-manage. You do not have to use life stage investment management if you're comfortable with the investment markets and asset classes, and you look at that and you follow that. You're more than welcome to self-manage in there. If you want to get that heightened sense of purpose through social value funds, you can self-manage in that regard as well. Or you have the life stage investment management program there on the left side. But again, as we have been saying, use that resource of EY Financial Planning Services to talk to them about the investment funds, talk to them about the investment markets and asset classes, and get that level of comfort that you know how you are positioned today in the investment funds and how that will work over time as you continue to accumulate and then eventually get your retirement income from your plans. We have a plethora of information on our website, wespath.org, plus other resources that are available to you. You can get the daily value. It's like a mutual fund. We get a net asset value. You can look at what the funds are in terms of fund descriptions, very high-level executive summary, or basically a prospectus where you can go deep into how the fund is set up and the holdings that we have at any particular point in time. Again, with benchmarking, we're looking for our results, and we have low operating expenses or fees in the funds, but you can see what those fees are if you go to wespath.org. So we've been contributing into the plan. We have it invested, however you want it to be invested, self-managing, life stage investment management. But as we know, life happens before retirement, and then certainly in retirement, you're going to start to access your account to receive some of your balances for needs and purposes down the road. So we're going to get back to Cheryl to share with us how and when it's best to access your account.
Great. Thank you so much, Frank. And a lot of great information regarding life stage investment management and life stage retirement income and how it can best pertain to you. But as Frank mentioned, accessing your account, we know that life happens. There may be different times when you may need to take this money out. It is yours. It is there for you. But just note that accessing your account can impact your retirement because you are taking funds out of there. But feel free to contact your financial and tax advisor, EY Financial Planning, just to see what those consequences would be. Now, but again, if you need to do that, that's fine. Here are some ways that you can do it. So to access your account prior to retirement, there's a list of different reasons here on the screen. Hardship withdrawals, in-service withdrawal at the age of 59, maybe due to a disability, separation of service. Like how I mentioned, you can roll money into Wespath. If you are no longer through the UMC and you terminated your service, you can roll that money out into another retirement plan. But the one that I want to focus on is the hardship loans. It is a unique type of accessing of your retirement plan because you will be paying yourself back interest. So that interest is actually based on prime plus a 2%. Now, you can take money out for a general purpose, which might be for about 5 years. Otherwise, it could be 15 years if it's for a primary residence. But with that in mind, the money that you have that is yours in your personal UMPIP account, that money you could take out up to a maximum of $50,000, but you are paying yourself back. So that would, right now, prime is 7.5 plus 2% is 9.5%. So instead of any of that money going to Wespath or somebody else, it's going back into your account. Try to make up for that difference of that of that earnings that you would be missing out. So that's where that is such a unique feature that is not out there in the marketplace for anybody else. Also, with UMPIP in retirement, what most of our people do is when you are retired now, you actually take a cash installment. That can either be through life stage retirement income, where again, we determine how much you can actually receive on a monthly basis to last for your and or your spouse's lifetime. Or you can tell us how much you want to take out on a monthly basis, whether that's $1,000 a month, $5,000 a month, whatever that may be. And again, you can change between the two at any time. You're also eligible to take out a partial or a full lump sum distribution of your amounts. One thing we do want to caution you on that is that if you're clergy, then there could be a housing allowance exclusion that you could be missing out on. But for laity, like myself and for Frank, this is something that is still a possibility for you to do. You're also eligible to keep that money on account until your required minimum distribution age, or RMD. If you're over the age of, so if your birth date is January 1st of 1959, then your RMD age is actually 75. So again, you can leave this money on account until you actually need it. Also, as I mentioned about the plan loans, prior to retirement, you can also have a plan loan while you're in retirement as well. So again, there's many different options that can be available to you. Please feel free to contact our customer solutions team, and they can go through the different options that are available to you and what might be best for you. Now that you've got your money and you're wanting, you have that money and it's built up in your accounts, we want to make sure that it's being spent right. So one of the things that we have is what's called life stage retirement income. We're very proud of this because this is an actual award-winning program that's been designed to make sure that your monthly retirement income is optimized the best for you for all of the defined contribution accounts that you have, whether that's the UMPIP account or any other clergy retirement security program, any other defined contribution accounts that you have with us. That's what this plan is designed to help make that the most that you can have through your retirement income. Annual adjustments are based on age and investment growth and loss. Again, as Frank had mentioned about that whole life stage and investment management and the glide path, this is all factors that are combined into helping make sure that the life stage retirement income that is provided to you is fully optimized for the long haul. The goal for the life stage retirement income is to provide that monthly payment that lasts for you and or your survivor's lifetime. Again, that is the goal. For every month that you receive that money from those buckets of money that you have accumulated from the UMPIP, we want that to be able to last for your estimated lifetime. And life stage retirement income works hand in hand with life stage investment management to provide that to you. With this, you have flexibility and choice. It is a defined contribution plan, so you can actually take distributions from these funds when you need to. You can actually add more money into that as well to help boost your amounts up. That could be rolling money over into the plan if you so chose. You're able to move money in between the life stage retirement income and UMPIP at any time. So there's no direct cost to that at all. And if you're in life stage retirement income, you can go back to self-managing. You can, and without that cost or any of those fees. We also have two optional types of programs that are associated with the life stage retirement income, and these are the Social Security Bridge as well as the Longevity Income Protection. And I'm going to talk about each of those in just a little bit, but each of these, you can take both, you can have one or the other, or none at all. So it is completely up to you. But we like you to be able to understand what those additional services are so that you can make the best choice when you're actually making that choice for your retirement income. So regarding the Social Security Bridge, this is something that can actually help supplement your earlier retirement by allowing you to defer for Social Security. And what that means is that everyone has what's called a full retirement age. That full retirement age can be different for people, but let's say I'm using myself as the example of mine is 67. So my full retirement age being 67, and let's say I wound up retiring at 67. If I want to receive as much money as I can, I know that I can actually hold off on getting Social Security until I'm age, 68, 69, 70. But every year that I wait to get my Social Security, I get an extra 8% per year bump in that Social Security amount. Meaning, if I wait until age 70, then I will get a 24% increase in my Social Security benefit. Okay, that's fine. If I want to wait until 70 to get Social Security, great. But what about those 3 years before that maybe I need to have that income? Well, that's where life stage retirement income can actually be the place that you receive most or all of your income from. It's from us, from Wespath, from life stage retirement income. So your dependency will be on life stage to receive your monthly amounts. Once you apply for Social Security, then your amount that you actually receive from Wespath would actually be decreased because then you'll be receiving Social Security. And then this is actually just a short investment allocation that's adjusted to reflect for the short time period of that bridge. So again, you can actually get Social Security at 68, 69, 70, whatever works for you, but knowing that that bridge can help supplement you in those years before you actually receive Social Security. So that's the bridge. The next one we have is the Longevity Income Protection. Now, this is actually a deferred annuity that you purchase through an outside insurer at retirement. So again, using that example, if I retire at 67, and let's say that I want to go ahead and go through with this longevity income protection, I would be purchasing this plan at group insurance rates when I retire. Now, the reason why I might do that is because this would help provide another steady stream of income over my lifetime. That those payments actually don't start until age 80. Now, this could be also for yourself and your spouse, but again, once you turn age 80 is when that actually will take place. I've made a lot of words here and described these two types of plans, so now I want to go through and give you an actual graph to show you how that can be. So when you actually are taking your money through life stage retirement income, all of your money is coming from life stage. So again, if I retire at 67, this is where all my money is going to come from. If I wait until age 70 to receive my Social Security, now I'm getting a higher boost in my Social Security amount, which means that my life stage amount has actually decreased because I don't have the need to have that much coming from life stage because I'm getting Social Security. Now, if I do the additional the longevity income protection plan, my dependency on life stage goes even lower because now I have that annual stream of income of the longevity income protection added to my Social Security. All right, so now we're going to go through participant resources and we're going to hand it back over to Frank.
Thank you, Cheryl. Yeah. So by now you can see that the plans that we have, the programs that we have are robust. And so there's a lot of information that is being shared with you today. Some of it may be clicking right away, some of it maybe not. This is why we have the resources that are available to you. Personal resources, educational resources that are there. First, we have the Benefit Access System. It's our web portal for you to access your account. Hopefully all of you with an account are on Benefit Access already. If not, it's a very simple way to log on. On the screen there to the lower right, if you can see that, there's an Enroll Now button. You can click on that. We're going to ask you to verify who you are, name, social security number, date of birth. Then how do you want to authenticate that you are who you are? Be it via text message, which I think pretty much everybody does now, or via email. And then once that's done, then you can set up your ID and your password and all of that. Now you have access to your account. Here you will be able to review your quarterly statements. As you're reviewing your quarterly statements, you may be in life stage investment management, get to the third or fourth page of the statement, see all these interfund transfers happening. You don't know why they happen. Now you do. We're working life stage investment management behind the scenes. We have online tools. We have our projection tool. You can go in and you can run what your account would look like with a potential income replacement ratio, your monthly installment estimate that you can receive by doing these projections. We have some assumptions built in there, but that's a great tool for you to get a gauge as to where you are now and what that looks like in the future. Again, you can find out about our investment funds, beneficiary designations, a lot of educational resources. As you get to each page, primarily each page, on Benefit Access, on the right-hand side, there's going to be a little bar there that's going to have educational resources that are relevant, in particular to the page that you're looking at. So, please take a look at that. You can get the education from there as well. With the beneficiary designations, when you set up your plan account, you want to ensure that your beneficiaries are set up. If your beneficiaries are not set up and in quote-unquote good working order, and something happens to you and your spouse, and it's not in good working order, then we're not going to be able to pay out your account to your named designated beneficiaries. It'll go to your estate. It'll go to probate court in whatever state that you live in. Will take years, cost money for it to come out, and may not come out the way you really would like it to come out. So with this, check your beneficiary designations or set up your beneficiary designations and make sure that they are set up correctly and in accordance with your wishes. You want to designate who in advance who would receive these benefits. Again, something tragic happens to you and your spouse. And primarily in an area where it's a marriage, the spouse tends to be the primary, with the children being secondary. But you can identify anybody as a primary beneficiary, anybody or institution, your church, your organization, your not-for-profit, as that designated beneficiary. It can even be a trust. If you have a trust set up within the overall household, you can designate the trust as a beneficiary. You want to make sure that you do that. Again, good working order, so God forbid something happens, but that money will come out quickly to those you want it to in the way that you designated. EY Financial Planning Services, they provide comprehensive, holistic household financial planning services to you at no additional cost. Those fees, those operating expenses cover the cost of utilizing EY Financial Planning Services. There is no limit on how often you can use them. It's not a number of phone calls per year or number of hours per year, and they will give you objective advice. During our benefit education consultations, we can help you think through and understand what your plans are, what our funds are, and all of that, but we can't really lean into advice and guidance where they're licensed and credentialed financial professionals, and they can do that. But they also will not be selling you anything. They're going to want to see everything you have as a household. So if they see a life insurance policy, they're not going to say, oh, I can get you into a better one, and then start to sell you on another one. Not going to do that. They're going to be focused on you and what's best for you and your family. There's the number that you can call. There's the website, wespath.eynavigate.com. You can utilize their educational materials, their tools, get an understanding of your risk tolerance, and all of that. Now, when we talk about EY, we often talk about the big picture type of stuff. Financial planning, retirement income planning, tax efficiency planning. We talk about all those things, and they are there for that. And we would recommend you use them. They are a financial advisor at no cost to you. But you don't have to use them for that purpose. You can call them as it relates to any financial question that you have. Should I buy or lease a car? How do I set up a 529 state college savings plan for my child or grandchild? Should I take out a plan loan that Cheryl reviewed to do something with the house or a vacation? Or do I need to take a distribution to do that to satisfy that need? They can help you with all of that. We highly recommend take advantage of that resource. They also provide webinars on a regular basis. This is a schedule of upcoming webinars that you can see right here. You can see this on wespath.org/events. So the public website that we have /events, you can see that. And upcoming, they're going to have one on Social Security. So continue to learn more about your financial life and your financial planning through utilizing them in person or the services that they provide. And then we have our one-on-one benefit education consultations. Here, using that link that you see there on the top, you set up a 1/2-hour consultation with one of us benefit educators, myself, Cheryl, that's Todd Creviston, or Bob Christoffel, who's the manager of benefit education. And we will go through your benefit access record, we'll look at your employment service record, we'll run some projections, and we'll be ready to have a robust conversation with you. We'll know how you're contributing to what and how much, and how your investments are allocated, and go through all of that with you. If we don't get through everything in the initial half an hour, it's not a one and done type thing. We go ahead and we schedule another consultation, as many as we need to get through the questions and the education that you're looking for. What we have found over time is our participants are coming through and doing a benefit education consultation prior to going to EY and having their initial conversation with EY, so they're better prepared to have that meaningful conversation with EY. We love to do them. We've been doing them actually since the pandemic came along, when we had to pivot to another way of providing services. We've stuck to it. It's been very successful, and we really enjoy doing that. And as Cheryl indicated, you'll get that link actually in the email that will come to you in several business days at the conclusion of today's webinar. We have our participant solutions area, our customer service area. That is our phone number there. And then for those who are getting ready to retire, we have a carve-out of that team called the retirement team. And you can call them, and they can work with you to understand what you need to do online through Benefit Access to make the elections as to how, when, and how much of your benefit you want to receive. So another resource that's available to you, there's something like 90 to 100 people that are here in our building that just do customer support, and then we have that carve-out of about 15 individuals that just focus on our current retirees and the current class of retirees and the retirees that we have over time. So a great group of people to work with and to deal with. Then I think lastly, Cheryl is going to walk us through some next steps, homework. You know, as Cheryl will say, it wouldn't be a webinar
without action planning and next steps. Excellent. So
There
thank
you
you
are.
so much. I appreciate you setting me up, Frank. All right. So a lot of great information, and as far as participant resources that are out there, please just know that you have people here to help you through this. So Frank and I hope that we've given you enough information that if you're not already enrolled in UMPIP, to go ahead and get started. It's a great plan. It's going to help you through and into retirement. Again, you choose how much to contribute from your paycheck. It's your choice. You determine your investment strategy. Are you conservative, moderate, aggressive? It is definitely your choice. Once you are enrolled in UMPIP, then you can actually register for benefits access and be able to access all of that information that's out there. You can get there from wespath.org, and then up in the upper right-hand corner, there's a red button saying Benefit Access, or simply go to benefitaccess.org. We want you to be able to review all the information that's out there. We keep saying robust information, a plethora of information. That's one of our favorite words. But there's all sorts of information out there for you. EY Financial Planning Services. I think we've mentioned them maybe at least 1,500
A dozen times, yeah.
Many times. So wonderful resource for you, a wonderful business partner that we've had. And again, another area is the one-on-one consultation with us. Hey, Frank and I are giving you this information now, but once you like to talk with us one-on-one, we're actually funnier in person. But this is all the next steps and why we do these webinars. So that is what we have for today, and that is concluding our session for today. So thank you so much for joining us, Frank. And on behalf
Absolutely.
of Frank
Thank you
and
for
myself.
taking your time
Yes.
today for us to share with you this information.
Yes.
Hopefully you have found it meaningful.
Definitely.
And actionable.
And yes, definitely. And I think maybe you should put this on.
No, that's okay.
No, okay. All right, then I'll put it back on. So, all right. Well, so thank you so much. Enjoy the rest of your day.
Take care, everyone.